Hello friends, welcome back to JK Shah classes. Today we will be revising this small chapter called tax planning versus tax management versus tax avoidance versus tax evasion. This chapter comprises of 4 small concepts. We need to understand the meaning of these 4 along with examples. Basically, there are 5 marks worth of questions asked by our institute on these points. Small questions which will have 5 points. For each point, you have to decide whether the given transaction of the assessee amounts to tax planning, management or evasion avoidance. Tax planning starting with, now these 4 things are to be understood from the perspective of the next chapter also, GAR, General Anti-Avoidance Rule. So, I will start with tax planning. Tax planning basically refers to systematic arrangement of the financial affairs of the assessee for obtaining maximum advantage of various tax deductions, rebates, exemptions, relief which are legally provided under the law. So what is it? I'll tell you. Tax planning basically refers to claiming maximum possible deductions which are allowed in a legal way. For example, under the old tax regime, if assessee is individual, any deposits in PPF account claims deduction under 80C up to whatever limit it is allowable, 1.5 lakh rupees, that is called tax planning. To reduce, the purpose is to reduce the overall tax liability but in a legal way. It is fully within the framework of law. So, if you refer to this table, we can conclude, this table I would have repeated at the end of the chapter also. Tax planning is legal also and it is ethical also. Morality grounds also it is correct and legally also it is allowable. Government itself offers us some discounts. Tax planning also refers to making a choice between 2 given options, make versus buy or purchase versus lease. Suppose any assessee wants some asset in his factory and instead of purchasing the asset he takes it on lease, then he will get deduction for lease rentals paid. If he purchases the asset, he will get deduction for depreciation. If he takes it on lease, he will get deduction for lease rental. Which option is better from tax perspective? That is called tax planning. Investing in PPF, Mediclaim, investing or acquiring specified bonds within 6 months for claiming exemption under 54 EC. These are all examples of tax planning. Tax planning also means making a choice between 2 given options, selecting a better option, such an option which gives maximum advantage to the assessee. There are different areas of tax planning, but that is not our concern. Tax management on the other hand basically means complying with the taxation law, filing IT return within due date, paying advance tax installment within time limit, depositing TDS, TCS installments, TDS, TCS within time limit, 7th of the next month. These are all examples of tax management. The aim of tax planning was to reduce the tax liability in a legal way, but tax management, the purpose or the objective is to reduce the tax cost or avoid the tax cost. What is tax cost? Tax cost means penalty, interest, fees, etc. Systematic and well organized steps taken to ensure compliance with the tax law within the specified time limit and in a specified manner to avoid any tax cost or minimize the tax cost. Tax cost basically means penalty, interest, prosecution. It is undertaken to fulfill the requirements contained under the provisions of law. Filing IT return within time limit, advance tax, TDS return, complying with the notice within time limit to avoid fees, interest, etc. That is tax management. On the other hand, tax avoidance, which is a smart way, tax avoidance basically means finding out the loopholes under the Income Tax Act and taking undue advantage of those loopholes. Arrangement of affairs to avoid payment of tax. Avoiding payment of tax in a legal way. Tax avoidance is totally legal, but it is unethical, meaning thereby this was not the intention of government. Government never wanted you to claim this, but you claimed it in a smart way by finding out a tax loophole. By the use of device which a sham or make to believe defeats the basic intention of the legislature behind the statute. In spite of being within the framework of law, it attempts to make an undue advantage of loopholes under the law. It is legal, but it is unethical. Transfer pricing, clubbing provisions. Now, whenever government finds out that people are taking undue advantage like this, government will introduce a new provision to plug the loophole. Even deemed dividend under 222E is the example of tax avoidance. Nowadays not possible after introduction of 222E clubbing provision. Once government plugs the loopholes by introducing provision, then it is no more possible. Prior to that it was possible. Tax evasion. Tax evasion on the other hand is totally illegal and it is unethical. Tax evasion means assessee manipulates his books of account, passes false entry, claims bogus expenditure, claims expenditure which are not incurred by him, artificially suppressing the income or inflating the expenditure by passing bogus book entry, that is called tax evasion. Totally illegal as well as unethical. Now tax evasion is clearly unethical plus it is illegal, falsifying or manipulating the accounts and thereby concealing the income with an intention to reduce tax liability or artificially inflating expenditure. So tax planning is everything legal also and it is ethical also. Tax evasion is totally unethical as well as illegal. Tax avoidance is something which clients are interested in. Tax avoidance is legal but it is unethical. So we can summarize as follows. Tax planning is legal as well as ethical. Tax evasion is illegal as well as unethical. Only tax avoidance is legal though it is unethical. And real life clients are interested in doing this. That's it. With that, the revision of this chapter is over. See you in the next video with some other chapter. Wish you all a very good luck.